Good morning again, everyone. That was such a good overview of Ultra that currently represents 30% of our total loan portfolio. So that's really exciting for us as well for 2023. And of course, we expect it to grow even further in 2024, but we'll just have to wait and see for that one. So for the period ended December 31st, 2023, we stepped on our targets and we really produced impeccable results once more. That really shows that we understand the assignment and we continue to learn and grow, right? So basically, as at December 2023, we saw total income moving to $1.2 billion, increasing by 64%. We also saw profit before tax coming from that, growing by 53% up to 451 million, which is really monumental for us. We also saw loan portfolio growing from $1.7 billion to $2.8 billion, moving by 65% year on year. Assets as well, moving to $3.4 billion, up 53%. And of course, this is mainly due to the size of the loan book. Cash and cash equivalents reduced marginally by 7%, but we're still at a strong cash position at $326 million. And total debt moved upwards to $2.2 billion by 60% due to the fundraisers we did in 2023, which really assisted us with the growth that we're seeing in the 2023 numbers. Now, let's move on to the next slide. Now, as at December 2023, cash and cash equivalents reduced marginally, as I mentioned. We did promise a healthier cash balance, and we have delivered on that. Our loan book, again, increased by 65% to $2.8 billion. And this is really due to the drive of the sales team and our collections team, since sales would have increased by 128% year over year. Lastly, on this slide, liabilities increased by 57% due to the fundraisers we did throughout the year with our new partners, Mayberry, and to a lesser extent, some of our partners at the parents level. We saw shareholders' equity moving by 37%, and this is really due to the increase in retained earnings by 101%. This increase is solely due to the increase in comprehensive income for the period. Now, income would have seen a similar increase to the loan book, growing by 64% year on year. And again, this is the increase in sales is what drove this increase in income. And then to a lesser extent, we would have seen some income from deposits held, but to a much lesser extent. Now, operating expenses also saw an increase by 50%. Due to the increases in staff costs, which grew by just about 57%, as we increased capacity to manage the current demand and the anticipated demand and growth of the company. We also saw increases in legal and professional fees still under expenses, audit fees and IT expenses as we increase security. On the IT side, we see everything that's happening and we want to ensure that we are heavily protected. And on IT as well, we had to prepare for new regulations such as Data Protection Act, which comes at an expense. Now, all of this would have led to a profit before tax of $451 million, which is an increase of 53% year over year. So we did see an increase in income, increase in expenses to a lesser extent, but we were able to meet, exceed our targets in terms of profit nevertheless. Now, lastly, on this slide, I want to touch a little bit on the EPS, the earnings per share, which stood at 17 cents, which decreased by 1 cent. Now, there are some concerns going around saying that, this seems to be very minimal growth given the growth in profit for the company. But let's look at how the EPS is calculated, right? The EPS is essentially net profit divided by the weighted average number of stock units in issue. Now, the operative word here is weighted. Now we know that we have $2.5 billion worth of stock units in issue. However, in order to get to that weighted number, we must look at how long those units have been issued relative to the end of the financial period. Now, in 2022, we would have issued just about $2.4 billion worth of shares in May or June, or between both months, to facilitate the IPO. So by the time we got to December 2022, the weighted average number of shares in issue would be around 1.5 billion. And you would see this also on the 2022 audited financial statements. So they really weren't issued for a full year, and we had to apply a weight to that. Now, as at June 2023, the weighted average on those shares would have balanced out and amounted to 2.5 billion, since they would have been in issue technically for a full year. Now, essentially in 2022, profit was effectively split across 1.55 billion shares. And in 2023, it's being split across 2.5 billion shares, which, if we look at the laws of math, amounts to somewhat of a lesser amount in terms of EPS. So to put things into perspective and put some context, if we were using the same weighted average as we did in 2022, EPS would be 28 cents per share. But because we have to use the weighted average, and it moved from 1.5 in 2022 to 2.5 in 2023, that number would have been 17 cents per share instead. Basically, we're splitting profits across more stock units in issue. Now, if we move over to the next slide, cash from operations increased over the period. Well, increased in the negative way over the period due to the lending. We are lending more, we're growing the business, and we continue to see where cash from operations is somewhat of a negative figure. But based on our estimation, based on the organic growth we are anticipating over the next year or two, we will see where this will start to change into a positive figure once we not exit growth mode, but once we get into more organic growth. Cash from investing also saw a positive change since we spent less on investing. Last year, we would have invested in short-term deposits to a larger degree, much larger degree than 2023, to ensure best use of excess cash. So where we saw cash wasn't being used as fast as we wanted it to, or we're waiting on deals to close, we would have done some investments to ensure that we're able to accumulate some income on that. Last year, 2023, we only did this to a tune of about $20 million. And lastly, cash from financing movements is mainly due to the payment of dividends, which increased by 80% year over year. Now, on the ratios, we notice a positive movement here on the efficiency ratio, moving from 50% in 2022 to 46% in 2023. And really, this means that we used less expenses to generate the income that we're presenting here today. So this is really positive for us, and we continue to operate as efficiently as possible to ensure that that bottom line is as unimpacted as possible. Non-performing loans also increased marginally, but still commendable and within our budgeted expectations, as our CEO mentioned. ECL also reduced to 3.8%, which is a positive movement, and it reflects the increase in the quality of the loan portfolio, as our CEO also mentioned. And this also had a positive effect on the P&L, because we do understand that we have to make a provision. And unlike the NPL, the ECL's provision is reflected on the income. Now, all in all, it was a very good period of growth for us. As I mentioned before, we understand the assignment, and we continue to ensure that the company is growing in an efficient way as well, while we continue to maintain the quality of the loan portfolio.